Hi, I'm Jenny Beaumont from CBSL Accountants. Any builder will tell you to make a really strong construction you need great foundations, and for us when we're talking about profit improvement it starts with the financial information. So this module is going to take you through financial information, maximising our inputs, our processing through to the output and reading the financials. So first of all, let's start with the inputs. Historically, accountancy has always been quite a highly intensive paper document environment, but actually with modern day applications and IT, we can really cut down our time and save and make efficiencies. So what I'm going to do first of all is give you a few examples of what you could be doing to input more data to maximise what you see on the outside. So first of all, I'm going to talk about auto entry. Let's compare it to if you're typing in an invoice. You get an invoice through the post, you have to type it in, you have to add in the date, the time, information on the financials, and then the VAT information. And although I'm always told, well, it doesn't take me long to put it in, if I actually put a stopwatch on you, it would actually take quite a while. In comparison, I can take that same document, scan it through a system, and auto entry will take and do that documentation for you. So it will auto-populate the date, auto-populate the invoice number, the financials, and also give you an image that lasts of that documentation that you can use in the future, either for yourself with an accountancy, as a director to review what the input's been, or as an accountant, instead of actually asking the director for information, you already have it at your hands within these accounting systems. And that's not just the only way to capture information. You can also capture information nowadays through an email, forward it on, and it will auto-populate, and even through your phone with an app, taking a picture and then send it through to the documentation. Just an example of what I did with a director of a mechanics and repair shop is he was dyslexic. He did actually already have an IT app for his invoicing. But this app was a very small app. It didn't integrate at all with an accounting package. The reason why he was using it was he hated to write anything down. He hated to type anything out. But we needed to use an app that was going to be useful for him and actually integrated into the IT system. Otherwise, as accountants, we'd have had to just retype out that sales information. Using the Xero app, I set up product information so that he could just simply put in a product code and already automated the description on the sales invoice for him. And it was an easy to use app that instantly allowed him to provide an invoice to his clients and move forward with his day. And there are other apps out there, other ways to capture. So we've got email capture, phone, even automation. So if you've keyed in an invoice once, and then you know that it's going to be the same invoice again and again and again, just a different reference, you can actually set these systems up in order to reoccur those invoices on a monthly, bi-monthly, 6-monthly periods for your own usage. So that's just one of the ways we'll capture information, and you might have your own industry specific one. So we've got Salesforce for customer relation management, ConnectWise is used in the IT arena, Vend for till systems, they will connect through into your IT, Zapier, Zoho and AgriWeb as well for the farming industry. So that's how to input data in a lot more of an efficient way to save you time, stop duplication, and also to just reduce human error as well. And let's think a little bit more about what actual accounting packages are out there. So first of all, Sage is more of a desktop product. It was certainly aimed originally at desktop, and it's still the default desktop package. But I want you to start thinking about cloud products. Cloud products, the default product out there is Xero. It was built from the ground up to be a cloud package, and because of that, it's probably the premier usage for small businesses to medium businesses in the market. And they haven't really changed for what you're seeing to what was originally introduced. And when updates do come through, it's really trying to make the actual tool itself more powerful. So the reporting side, better editing abilities, the phone app usage, far more features are now coming through onto those systems. because if it's not broke, don't try and fix it. QuickBooks is probably the next default cloud package on the market, and QuickBooks is, for me, the closest that I can see related to the desktop. So if you don't want a really large change to your processing, probably QuickBooks is a really good choice for you, although I think you're going to see a change anyway going from the desktop to the cloud package. It is more simplistic though. In order to bring it up to cloud level, I have found that some of those features that you get in the desktops are a lot more lighter, more simplistic, and you could feel like you're getting something less than what you had previously. And certainly if you can't find it has a feature that you previously used for desktop, probably ask us. We can normally find a workaround and try and tailor make how you're doing the process in order to fit into the new cloud-based packaging. So QuickBooks are good, a few quirky features on them around the bank and the VAT, and it's probably just knowing a few of those points in order to make sure you're not making mistakes through them. Sage itself, it did try to go down the cloud route, I think more as a knee-jerk reaction to Xero. But really it was too quick, it didn't quite get it right. And since then, I think because of that early knee-jerk reaction not working, it's not really been a tool of choice for accounting packages. And Sage themselves, their focus is still on the desktop. They've got a wide variety for small, medium and larger businesses to be able to use certain desktop packages as a powerful tool. So we can really help you with all those packages. You have to put the time in to train on them, to really understand those features. Otherwise, what's going to happen is you're kind of going to come across them and discover them months, years later, and it could have saved you an awful lot of time on the front end. So just ask us about our training facilities, because we could really help you get a quick start on using them. And then finally, if we've maximized our input process, we should be getting some really good output information, and this is our profit and loss and our balance sheets. And really, to make the most of those profits and loss and balance sheets, what I would say is there's three important factors going in them. What's the basis of your accounting information? Are you using cash or accruals? How much are you segmentating the default chart of accounts of sales? Are you defaulting it enough so that you can actually see differences in sales? And then finally, what format are you using? Are you just looking at 1 month or one period, or are you trying to look at a trend running through using time analysis? So we'll go on to those 3 points next. Okay, so first of all, we're going to start by comparing our cash to accruals. And here I've had quite a few conversations with directors. You know, they're doing a great business controlling their business, but they can't always understand some of the mechanics behind accountancy, and the default position is to go through to the bank. I know what cash I've got, I can see money coming in, I can see money going out. It's very simple, and I understand that. But if you use proper accounting principles to look on your accounts on an accruals basis, you'll actually cut out a lot of those influences that are giving you skewed, incorrect information. For example, if we look at the graphs here, we can see that in Q3, we're looking like we're making a really good profit. Now, the reality is we could have just been paid by that customer an awful lot sooner. And if we're trying to predict what we're going to see in terms of profitability next year, that same said customer might now be in financial problems, and instead of paying us at 25 days, they've actually pushed us out to 65 days. So now Q3 is no longer a good quarter for us, it's now going to move to Q4. And we've got nothing we can control about that, nothing that we can predict. So we use accruals-based accounting, and that means that we can get accurate numbers, we can actually see sales matching through to expenses in order to give us those profit margins. And it's not just that, we have also the continuity so that we're able to predict budgets and create correct targeting for ourselves. And not least, if a bank does actually need to provide any financial support to you, they will expect your accounts to be in an accruals-based format. But don't worry, because these accounting packages give you the accruals-based format, but you still have dashboards that direct you through to any cash positions that you need to look at. The second piece that we're going to look at is segmentation. So how are we setting up these cloud-based systems? And there's a few options that we have here. Again, the default is probably to the chart of accounts, and we can start to see some very busy chart of accounts where someone's taken the default sales position and then actually set up another nominal ledger code that splits information down. And that's great, but it can really start to make your chart of accounts extremely busy. And then when it comes to tying this through to editing your profit and loss, a little bit more cumbersome. And different systems will do different things to help you through. So we've got the QuickBooks system that will try to give you subcategorization. So when you look at your profit and loss, you have sales, but then you can filter it down to give you more information going through those categories. And all the systems will do something like that, but just slightly different. So you can have department codes that will mean that you have your key financial information, but you can allocate it through to, say for this example, beef, or we can allocate it through to lamb for our sales. And then we can even put in tracking systems as well, so that we can look at our our products, or we can look at our sales and do an analysis and just track if we are selling beef through our butchery system, or if we're going through retail, i.e. we sell in and we buy in and we sell in the same product. So a few different ways to try things. We've also got non-tracking stock items. So stock items will track through a system, but we can use non-stacking inventory in that we utilize it simply for the code and it will give out a description. The great thing about doing that is because one, it's not moving mechanisms through the system if you haven't really set up your stock system correctly. Two, it gives us a static figure. So if we did do an analysis of your sales, we have a static code that we can then look at and pivot to see where the sales are through the business. And then don't forget that you can also link these with your own industry specific apps. So information through from Vend could give you more selling information that allows you to have that depth of sales information whilst also keeping a really good concurrent profit and loss to be able to look at. And don't forget, when you're looking at revenue, we've also got the costs that relate to that revenue as well. So try and mirror the two, and by mirroring the two, you're able to start to see margins coming through from that. So if we have sales of beef through our retail system, then we want to know the costs related to buying beef in through the retail system as well. And finally, we're going to just think about formatting. Within formatting, we've got a lot of options and it can start to make things look very busy. But if we first of all just take our simple profit and loss on the left. So we start with sales, and like we've shown, we can analyze that in depth in different ways. We then have our cost of sales and overheads, and this can be a conversation in order to clarify what goes into what element here. Let's take overheads first of all. Overheads are costs to a business, and that's any business that we would typically see that cost for. So rent, heat and lighting, rates, insurance. They're all typical items that you would have in relation to having a business. Whereas let's compare it to our cost of sales. Our cost of sales are those expenses related to running your individual business. So if we go back to the butchery, we're thinking, what's the cost of buying in those products, transportation, packaging, and they're very much volume based. So the more you sell, they're connected to the more that the cost will go up in relation to what you sell. Whereas overheads are devoid of that. They should really be fairly consistent. And if you're doing your journals correctly, they really shouldn't be part of the conversation too much, other than saying, if we're seeing too much weight in an overhead, then trying to reduce that down. But what I want you to think about is really tackling the sales and the cost of sales elements. They'll be your focus for the business. Now let's move on to the right-hand side, profit and loss. And this one is a much busier, but much more information is packed into this same report. We can have a look, we can look at trend analysis through your quarters. We've also split down the sales to the cost of sales, so we can start to understand our margins through selling A to selling B. And I think, as we can see, A is a lot more successful. And then don't forget, if you're correctly applying the accounting principles, you're splitting the costs correctly. So we've actually taken 4,000 out of our overheads because this was purely for agency staff to cope with the upsell of B. And as you can see, then we get a slightly different gross profit margin. We get a slightly different net profit margin, but it helps to clean off the overhead so that what we're seeing is a consistent number. The other element of that is when we reviewed Q4, we could see that an item had gone in that should have been capitalised. So actually we've reduced our overheads because that should have been taken onto the balance sheet. So it's just really making sure you're thinking about these formatting and the principles of accountancy in order to get accurate information for you to base your decisions on. What we're going to go on to next is just thinking about the balance sheet. And the reason why we're going to think about the balance sheet is very often this is not part of the conversation, this is not part of your consideration. So I just want to understand what the balance sheet is trying to do for your business. And we'll just start first of all with the fact that it's a balancing item. So if we're seeing items across in the expenses and profit, we're trying to balance that out into our balance sheet. So if we look at prepayments and we'll think about rent, we've just received an invoice, it's ahead of time for the following 6 months. We don't want to be hitting our profit and loss with 6 months worth of cost in a singular month. Instead, what we do is we take that across to our prepayments on the balance sheet, and then we split those through monthly so that we get that smoothing of our overheads, and we're understanding that that is actually an asset because we've already paid for it and it's been expensed to us, but we haven't consumed the cost of it yet. Another example that we can look at is probably our fixed assets. So again, it's just making sure that if you have a high cost, a one-off cost that has actually got a larger consumption life, we bring it onto the balance sheet and then we split it down gently over time into how it's consumed by the business to make sure the profit and loss is an accurate reflection of usage. Another point for the balance sheet is there can be quite a few hidden costs sitting on the balance sheet. And this is if you don't have someone regularly reviewing and checking back to a few control points. So for example, stock. What we do at this point is we have an item on our balance sheet that tells us we have stock figure. Now we also then look at our stock sheet, and if they don't add up, and I find with customers, if this isn't closely monitored, it won't add up, it means that we have to adjust our balance sheet to correctly match our stocking sheet. And that has to go somewhere. So if we've over-egged our stock, we've said we've got too much, we need to reduce it down, the only place we can actually move that across to is to our cost of sale, which will decrease our profits. And that can sometimes be a hard conversation to have because you think you're in one position, but you come along and we'll review your accounts, look at your balance sheet, and we might need to make those adjustments. So it's far better to make sure you're making those judgments on your profit on a correct profit. Okay, and just to summarise then the importance of management accounts and why they are such an important tool for us. If we're making sure we put the correct inputs, processes, it's going to maximise the information that we're working with on the back end. And that information is then used for decision making, controlling the business, forward planning, and all the rest that we have listed down there. One thing I would say though is try to stay objective. Companies, you spend a lot of time with them, they're your babies. It's quite hard to then sit back and reflect on them and take any level of criticism or what can we do better. But really you need to stay objective. This is about maximising profit, and the only way we're going to do that is to look at what's currently happening and improve it.